Hi there. The title of this report is Risk Return Characteristics of the Australian Equity Market and its Resilience to a Global Pandemic. For the introduction of this report, the purpose of this report is to investigate the risk-return characteristics of the Australian equity market and compare the normal market conditions with extreme conditions. First, we start with the methodology and empirical results. Three methods have been applied in this report. As you can see in this slide, they are single index model, Fama-French three-factor model, and the event study. Before we start looking at these methodologies, let's check the statistical description of the data that will be applied in this report. Slide 4 is about the statistical description of ESXO ordinaries, and 5 companies. The author has chosen that from healthcare equipment and services industry, which become more vulnerable during the pandemic of the COVID-19. Slide 5 shows the other 5 companies that are resilient with the pandemic. Slide 6 and Slide 7 are about ASX Ordinaries Index and other 10 companies' performance during the normal market condition. Then a comparison between them should be made. From the descriptive statistics, it can be seen that the weighted average industry portfolio return turns into below zero during pandemic period, and standard deviation changes from 0.7% to 2.2%, which presents the risk become higher. And for other individual companies, generally, for those companies from the healthcare equipment and services industry, their average return has significantly increased. Also, their standard deviation have dramatic increase. And for those companies from the retail industry, their average returns and standard deviations have minor changes. Next is about introduction, assumption, and empirical results of the methods used in the report.
Slide 8 shows the definition of a single index model. A single index model decomposes stock return into two components. A component that relates to systematic risk, and a component that relates to non-systematic risk. It assumes that only one macro factor will cause stock return risk, which can be expressed by the return rate of the market index. According to the assumption of this model, the return on any stock can be broken down into the expected return on individual shares, represented here by a factor alpha. A company specific, the return on macro events that affect the market, and the unpredictable compensation of micro events that only affect the company. Therefore, macro events such as changes in interest rate and labor costs can cause systemic risk that affect the return of the entire stock market. Companies refer to events that are micro events that cause changes in a particular company's earnings. There are several assumptions about this model. First, most stocks have positive covariance because they react similar to macro events. Second, some companies are more sensitive to these factors than others, and this sensitivity is controlled by the coefficient. Third, covariance between both are due to different levels of response to macro events. So the covariance of each stock is equal to their multiplied by the market variance. First, you can see the equation here. The equation of the single index model is showing in the slide 9. The regression results are showing in the next. Another model is a multi-factor model, which is represented by Fama-French three-factor model. Fama-French built a multi-factor model with three factors: IM, IF, SMB, HML, to explain the return of shares. The slide 13 shows the assumption of a pharma French three-factor model. First, there are a large number of investors. Second, all investors plan their investment portfolio in the same securities holding period. Third, the scope of investment is limited to assets trade on the open financial market. Fourth, no securities transaction cost, commissions, safe fees, etc., and taxes. Fifth, investors have the same expected value for the main balance and account balance of securities returns. Sixth, all investors agree on the evaluation of the securities and the economic situation.
The slide 14 displays the equation of the pharma French three-factor model, and the empirical results are shown in the next slide. Okay, let's look at the slide 15. There is plenty of empirical results. Then please move to the slide 16. The slide 16 presents the definition of the event study and the review of relevant literature. The event study is a common method to study the impact of economic events on corporate value. The earliest adopter was Dowling, who studied the price effect of stock splits using the event study method. Ball and Brown introduced the current event research method to study the information content of earnings, and Pharma studied the stock dividend effect. Brown and Warner further refined the event approach by revising several statistical assumptions.
Slide 17 shows the forecasted equation for the 10 companies under the formal French three-factor model, and those equations are used to calculate the forecasted return for normal market conditions. The slide 18 presents the forecasted result, and slide 19 shows the abnormal return based on which the average abnormal return is calculated. At last, the slide shows the limitation of study. For formal French three-factor model, it cannot totally present the asset pricing model, as there are many factors which are not interpreted by formal French three-factor model, such as the short-term rewards, medium momentum, volatility, gambling, etc. For one study research method, the limitation is that it is difficult to isolate the presence of other factors, such as the state of the global economy, which can affect the reliability for the final conclusion. Thank you for listening our presentation.